Okay, right. So today we'll be talking about impairment. This is the next chapter in our series of chapters. We reached here in chapter 5. So before we move forward, a little bit of prologue about what exactly is, impairment. So what do you mean by impairment? What do you mean by impairment?
It's invalid opposite.
Yeah, so let's make it a little bit more easier. Okay, instead of using jargon. So let's say that you have an asset. Okay, and asset has a carrying value of 100. Okay, but the same asset would have a market value or fair value of 80. Right? Now, do you tell me honestly, do you think it's good to carry that asset as 100 in your financial statements and let the users of financial information really understand that the value of a particular asset is 100? Would it be a nice gesture in for presentation? At what value should you show your asset? Am I audible? Yes, you have to show it at fair value, but you understand the gist, right? Basically, we should be showing relevant information. And if I show the carrying value as 100, but the fair value is only 80, it would give a wrong picture for the users of the financial information. They may tend to overstate that the company has a larger asset base when in reality it doesn't. So then, we have to do something called impairment. Okay. Now, when do you do impairment? When do you do impairment? Now, see, the standard does not fix a particular time for doing impairment. What they see is that you have to always check for indicators. So there may be external indicators, okay, and there may be internal indicators, which would show that there is a chance of impairment. So, what do you mean by external indicators? Can you give me some examples of external indicators? It could be technological advancement, that our asset is obsolete, right? So, let's say that you have a lot of Nokia phones, okay, and you bought it for 10,000 bucks that day. Do you think that it would sell for the same 10,000 now? No, because there would be some technological advancement and the asset is obsolete. So it needs an impairment. Okay. There could be a chance when the interest rate has changed or interest rate has increased. So basically, if you know, when we do value in use or when we do the present value of future benefits that I could get from the asset, the interest rate is a very important factor. If the interest rate is more, that means the discounting is more and the present value will be less. If the interest rate is less, then the present value would be more. Correct. So if the interest rate at which I am doing my discounting, if my external borrowing rate or incremental borrowing rate, as the standard says, has increased, then obviously there would be a chance that your assets would also be impaired because the present value of expected benefits would be discounted at a higher rate of return. Did everybody understand that? Interest rate increase. If you didn't, just tell me. Would love to explain it again, but it's just basic financial management. Did you understand why I have to do an impairment when the interest rate changes or interest rate increases? Yes, okay. What could be other external indicators? Another external indicator could be that, your total carrying value of asset is more than the market capitalization. So your whole, what is meant by market capitalization? Market capitalization is nothing but what is the fair value of my shares, okay, or my listed price in the stock market into number of shares. Okay, if I do my market capitalization is far lesser than the carrying value of my assets. So that could also be an indicator that you have to do impairment. Now, this does not mean that there is a impairment. No, it just means that now you have to check for an impairment. Okay, and if there is an impairment, then we will do. What are the internal indicators? There could be internal indicators also. Internal indicators like uh, let's say that the idle capacity of the particular asset has increased. What do you mean by that? It means that I'm not using it anymore, using it as much anymore. Okay, maybe because you bought new asset and the new asset is performing well, or you like the new software. Do you think that it is less risky when it comes to employees working on it? So many factors. If the idle capacity is increased, or if there is any damage, or needing frequent repairs, then this could be considered as an internal indicator. Now, there is no hard and fast rule that these are only the external indicators and these are, yeah, my connection is unstable. Yeah, so there is no hard and fast rule that these are the only external indicators and these are the only internal indicators that you have to check for an impairment. But the thing is, you know the gist. Whenever there is an indicator, you should see whether it could contribute into the asset being obsolete. Okay, so these could be few things. Any doubts there when we do impairment? Hmm? And what the standard says is that you have to check four indicators every year, especially when it comes to assets like goodwill. Okay, check for indicators every year. They're not telling you to do an impairment every year. They're just telling you to check for it. It's a good practice to check for indicators every year. Is that clear when we do impairment and what is impairment and when do we do impairment? Is it clear? Any doubts? Okay, fine. Now, how do we check for impairment? How do we check for impairment? How do we check for impairment? I told you if your carrying value is more than the fair value, then you have to check for impairment, obviously, because it's not nice to present it in a way that is not right to the users of financial information. So what the standard says is that, like, fair value can fluctuate. So first you have to take the carrying value and you have to check with what we call as realizable value. Okay, you have to take the carrying value of asset and you have to check with what we call as the realizable value. Now, what is realizable value? Realizable value is nothing but the higher of fair value minus cost to sell and value in use. And don't worry about what these are. We'll check about it. Now, this, I think the logic is clear to you. Okay. Like, why I have to check with a realizable value, because it's not nice to kind of put something more than what it is in the financial statement. Okay. Now, how do we find realizable value? We will first understand what is the fair value of that particular asset. Okay. Now, let's take Nokia phone. What is the fair value of that asset? Very low. Absolutely low. No, nothing. It's just throwaway prices, right? And what is the value in use? Value in use is nothing but the present value of future benefit that I can receive from the continued use of asset till its useful life. Okay, now what the standard says is you have to take the higher of fair value less cost to sell or value in use to understand the realizable value. What could be the logic for it is, see, sometimes it may be just Nokia phone. You see that the market is dominated by Apples and Samsungs and Redmis and Xiaomis. There might not be much fair value, but end of the day, it kind of gets my work done. Okay, the value in use is good because I can make phones, I can do whatever I want. It's only that it does not have a fair value, right? The benefits still remain the same, if you ask me. So that is why the standard asks you to take the higher of fair value of that particular asset in the market or the present value of benefits I will receive from the asset by continued use till its useful life. Getting it? The logic, are you getting it? Why the standard is placing such a logic? If you understand the logic, it is very easy to understand. You don't need to memorize it all. Did you understand the logic for realizable value being higher of fair value or value in use? Yes or no? Okay. So see, standard is principle based. It's not just saying that fair value is low. No, no. I have a benefit coming from it also. Like, it's not just that my point, I'm dealing in these assets. If it's an inventory, yes. If the fair value is less, I would reduce it down. But it is not an inventory. It is my asset. Okay, which I use. What is the definition of asset? Which is used in production of goods or supply for administrative purpose or for rental purpose. So that means even if the value is less, I would just get a benefit out of it. Okay. So did you understand what is fair value and value in use also? Don't think there could be should be any doubt. Okay. So in such a scenario, this is how we will check for impairment. We will check the carrying value. It is not the asset value or the cost. Okay. I think we established the difference between cost and carrying value. Carrying value of the asset, check with the realizable value. And if the realizable, and how do you find realizable value? It is higher of fair value, less cost to sell, like, related transactions, transportation, brokerage, etc., which you have to, incur while selling the asset, and also the value in use. The higher of this, you would take it. Is it clear? If it is clear, let's go on to the next one. Now, how do we do accounting for impairment? How do we do accounting for impairment? So whenever there is an impairment, so let's say the carrying value is lesser than, so let's say that carrying value is 100 and realizable value, how do I calculate? The higher of fair value and value in use. So realizable value, let's say, is 80. What would be the entry? Where would I give the remaining? I would take it to, yeah, what would be the entry for it? Can somebody tell me the entry? I did the impairment exercise and I found that the carrying value is 100 and the realizable value is 80. What would be the entry that I will record once I get hold of this information? Okay, impairment debit to asset credit. Fantastic. Impairment debit to asset credit. See, this is what I don't like about you guys. Even after telling you that the asset value is always one, it will not change. What is the formula for carrying value? I told you for a PPE, it is asset value minus accumulated depreciation minus accumulated impairment loss. So it will not be charged directly to the asset. Instead, it would be charged to impairment loss account. So it would be, what would be the entry? Impairment loss, which would be going into SOPL, and it credit would be to accumulated impairment loss. How much? 20. Yes or no? Same thing you were doing in depreciation also. That's when we kind of told you that it will not go to the asset, in rather it will go here, and this is where we will accumulate it. Clear? Okay, fantastic. So this is how we will account any impairment. It will go directly into SOPL. Okay. Now what tricks could it become? Sometimes what we see is whether there is there any process that reversal of impairment. Would there be a reversal of impairment? There could be. The standard says that yes, there could be a reversal of impairment. Now, don't confuse it with revaluation surplus and all. So, what it says is you have to be very definite. So, once you say that an asset has been impaired, and now you find you say that its realizable value has increased. Okay, then there should be a solid base for that. Now, what I'm trying to say is now the carrying value of the asset is what after impairment. After impairment, what is the carrying value of the asset? It's going to be 80, correct? And let's say that after 3 years, I would say the realizable value is 150. Okay, connection is unstable. Yeah. So now my connection is back. So 80 and 150. So let's say carrying value is 80 and realizable value is 150. Is there a reversal of impairment now? Yes or no? Yes, in case of a reversal of impairment, what the standard says is, first of all, you have to tell me that this is honest. Okay, this is not an error. Because, see, revaluation loss happens, okay, on assets. But in case of impairment, if we did an impairment after all these indicators, we have to be disclosing that these indicators are now over. For example, let's say I had a Nokia phone and now there is a big demand for Nokia phone because it only has the amount of cobalt which can be used, because we have run out of cobalt reserves. Only old Nokia phones have the cobalt reserves, so now its fair value is way higher. Something really extraordinary should happen, then only there would be a reversal of impairment. Okay, and that fact that there is a conclusive proof for reversal of impairment should be disclosed. Then only we should do reversal. Now, at the time of reversal also, what would be the entry now? So carrying values 80 and realizable values 150. What would be the entry now? To how much amount would I reverse the impairment? The standard says that even though the realizable value is now 150, we will change it back. Okay, we will debit accumulated impairment loss and credit, um, SOPL, impairment loss, SOPL, just a reverse entry, only to the extent that the asset comes back to what it was before impairment. Or if the impairment had not happened at all, then what would be the carrying value? We can only, even though it is 150, we can only raise up to 20 so that the carrying value of the asset is 100. Okay, so wow, in case if the impairment did not happen, what would be the carrying value? Now that should be how we have to reverse impairment. But it is allowed, but you have to understand that reversal of impairment is a very rare case. Okay, there should be something extraordinary that should happen to an asset which we impaired. So in case of such an extraordinary feat, then that feat should be disclosed in the financial statements also. Clear? Yes or no? Okay, perfect. So with all that introduction, okay, we will go in and see what is written. Impairment is a relatively easier standard, very easy standard, but you have to understand the logic of why certain things are done. Then you can kind of do it. So let's go and read the, okay. So let's see. So impairment is determined by comparing the carrying amount with the recoverable, not realizable value. It's called the recoverable amount. Okay. This is the higher of fair value, less cost of disposal, and its value in use. There is an established principle that assets should not be carried above their recoverable amount. An entity should write down carrying amount of an asset to its recoverable amount if the carrying amount of an asset is not recoverable in full. IAS 36 puts in place a detailed methodology for carrying out impairment reviews and related accounting treatments and disclosures. I think this should be clear to you, the logic of the standard. Okay. Now, IAS 36 applies to all tangible and intangible and financial assets. Okay, so it's not just tangible here, it's tangible, intangible, and financial assets, except there are a lot of exceptions in the scope. Inventories. Okay, there won't be anything called an impairment of inventory. Okay, it would only be like IAS 2 tells us to do take what cost or net realizable value, whichever is lower. So there, in case of an impairment, we'll say the net realizable value is lower, but IAS 36 does not apply to. Okay. We use the term impairment of inventories very frequently in our work, but don't do that. It's only because the net realizable value is lower than cost. It is not impairment as per IAS 36. Now, what are the other exclusions? Contract assets and assets arising from cost. Now, what are contract assets? You know what is contract assets? We did IFRS 15. So, if there is any contract asset, that means we have built an asset for the customer, but we have not received money yet. So, it's accounted as an asset. That will not be impaired. Okay. Or IAS 36 would not apply to that. Deferred tax assets. No, sorry. Now you tell me why there are okay, deferred tax assets. Okay, assets arising under employee benefits, financial assets and scope of IFRS 9 financial instrument. Anything which is and financial instrument when under the scope of IFRS 9 will not be there, and investment property under IAS 40. Now you tell me logically why the impairment scope does not extend to all these standards. It's clearly and very fundamentally because these standards can take care of impairment by itself. If you see inventories, as I told you, there is cost or NRV comparison. So that takes care of impairment independently and individually. Contract assets, obviously. Okay, if the value, you have to have that work completion certificate and value certificate and also it takes care of it automatically, right? We have an input method and an output method, you remember, for contract assets. So it takes care of the valuation, external valuation by itself. Deferred tax assets also, tomorrow if it really reduces the tax payable, or next year if there is no benefit that is coming out of the deferred tax asset, and obviously we will disintegrate it. Employee benefits, because it's done in fair value. IFRS 9, obviously fair value through OCI and fair value through P&L. So it's done through fair value. Adjustments are done every year. There is no need for an impairment. Obviously, investment property is also what we studied it yesterday, that we use fair value, right? So since we use fair value, there is no reason for doing an impairment at all. It's kind of restated to fair value every year. So that is why these standards or these things, it will not apply. Okay. So we have to be very clear. Now you tell me, is there any impairment of AR, accounts receivable? Would be a case of understanding the scope. can we say that there would be a impairment of AR? Yes or no? Tell me. Would there be an impairment of accounts receivable? Yes or no? Am I audible? Would there be impairment IAS 36? Would it affect your AR? Okay. Ashik says no. Why no? Why no? Why wouldn't I impair my AR? If I have a very big outstanding. Um, okay, it is under IFRS 9, that's fine, but I don't do fair value adjustments to it, right? I told you we do fair values mostly, uh, you know, here you see that IAS 36 applies to all tangible, intangible, and financial assets, except financial assets with the scope of IFRS 9, financial instruments. You are telling me that AR is a financial instrument, which is carried on at fair value through OCI or fair value through profit and loss account. That's what you're trying to tell me. Anybody else? You guys are doing a lot of accounting. Okay, so why we are not doing it for AR is because there is something called provision for expected credit losses and ECL provisioning, and which is systematically tells us to what if there is any receivable more than 365, I'll be provisioning it 100%. Right. The value of AR that you see in SOFP after all this provisioning would be enough to take care of impairment. So enough, like, it is already after, like, even greater provision than impairment. So it's not required. So that is the logic. And okay, there is one more standard, which is IFRS 5. So if there are any non-current assets held for sale and discontinued operations, then also, impairment won't apply. Why? Because we will be carrying it in its fair value. Okay, as simple as that. So, impairment loss is the amount by which the carrying amount of an asset or cash generating unit exceeds its recoverable amount. Very clear. Carrying amount is the amount that the asset is recognized after deducting any accumulated depreciation and accumulated impairment losses thereon. Okay. The basic principle underlying IAS 36 is relatively straightforward. If an asset's carrying amount in the financial statements is higher than the value it can realistically generate, measured, the asset is judged to have suffered an impairment loss. Very clear. It should therefore be reduced in value by the amount of impairment loss. The amount of impairment loss should be written off against profit immediately. The impairment loss usually be presented in the operating category of the. That's fine. We have not discussed IFRS 18, so we will come there and we will know what is operating investing and all. Okay. So the main accounting issues to consider: how is it possible to identify when an impairment loss are occurred? I think we did that. How should the recoverable amount of the asset be measured? Yes. And how should an impairment loss be reported in the financial statements? This is what we did in the introduction. Okay. Now, how do you identify a potential impaired asset? You have external source of information. Okay. So if there are indications, the entity is to make a formal estimate of the recoverable amount. Okay. And what are the external sources of information? These fall in assets market value, significant change in technological market, legal or economic environment, an increase in market interest rates or market interest rates of return on investments likely to affect the discount rate used in calculating value in use. I hope you are clear with that. Okay, and the carrying amount of entity's net assets being more than its market capitalization. So these are the external sources of information. Okay, even if there are no indications of impairment, the following assets must always be tested for impairment annually: an intangible asset with an indefinite useful life and goodwill acquired in business combination. So all the other assets, we will only see if there is any possible indication of impairment and then go, right? Here, in respect of goodwill and an intangible asset with an indefinite useful life, we will calculate recoverable amount Okay, whatever is VIU and whatever is the fair value every time. Okay, right. Now, measuring the recoverable amount of an asset should be measured at the higher of fair value less cost of disposal and its value in use. I think this is clear. And if there is an active market, the fair value should be based on market price. If there is no active market, it must be estimated. So these are like just IFRS 13. Like, you have to see if there is an active market, you use level 1. If there is no active market, you use an estimate. That is level 3 fair value setup. And what is value in use? We understand. Okay. Now recognition and measurement of impairment loss. Okay. So can we do this question? A co holds an item of machinery which believes is impaired. The following information is relevant. The machine is held at historical cost. Fantastic. So it's at cost basis of accounting. The carrying amount of the machinery is 10,500. Okay. The fair value of the machinery is 10,000 and the cost of selling is 500, and the present value of the value in use of the machinery is expected to be 9,000. Determine whether the machinery is impaired, and if so, calculate the impairment loss. Now I think you can do it. Come on, tell me what is the answer. Whether the machinery is impaired, absolutely the machinery is impaired because the values are lesser, so there is no question that it is impaired. But how much is the impairment loss? You calculate and tell me from this example. Yes, it's simple mathematics. Sahil gets his first. He says 1,000. JJ also says 1,000. Let's see how he got 1,000. So the carrying value, this is after like, accumulated depreciation. It says carrying amount. Carrying amount is 10,500. Fair value less cost to sell is 10,000 minus 500. That is 9,500. And present value in use is 9,000. So the higher of 9,500 and 9,000 is the recoverable amount, and the recoverable amount is 9,500, and the carry and the impairment is carrying amount 10,500 minus recoverable amount, which is 9,500. We get 1,000. So fantastic, guys. It's as simple as that. Okay. Now this I don't want to do. It is because they are just doing present value of cash flows. I think you know how to calculate present value factor. Okay, for each year and do. So let's not waste time on mathematics. So this is fine. Let's not waste time to find the value in use. Most probably it would be received, but I think you guys know how to find the present value factor, right? Yes or no? 1 divided by 1 plus r whole raised to n. You understand how to do present value factor, right? Basic AFM, yeah. So let's skip this because it's too much mathematics. Now we'll go to cash generating unit. So that was all the introduction part, the reading of the introduction part, which we kind of saw. Now let's go to a new thing which is called cash generating unit. Okay. Now what is a cash generating unit? Cash generating unit is nothing but, see, what did we say? How do we find the recoverable amount? Recoverable amount is higher of fair value and value in use. Correct? Right? Now, problem is like, sometimes some assets you cannot establish what is their independent value in use. Okay, what is the present value of cash flows that is coming from those things? We cannot estimate because these are interconnected. I'll give you an example. So let's say that there is a machine. Okay, there is machine one, and then there is machine two, Hmm? And it's connected through a rotor. So I draw a rotor. So let's say that it's connected through a rotor. Okay, this is not a small line. This is a very big thing. It's connected. The goods actually go from, if you input the goods here, it will be, processing it, and then it will go through this, rotor, whatever you call, to machine two, and then, or this pipeline, and it goes to machine two, and machine two processes and gives the. Okay, so this is the asset. Now, how we might have accounted it as three assets, right? This would be asset one, and then there is asset two, this one, right? And this is asset three. So in such a scenario, when each asset is interdependent to each other to kind of generate cash flows, how do I find the value in use? I may get the fair value of each asset, but how do I get the value in use? And the standard specifically says it should be the higher of fair value and value in use. So I would be in a fix. Correct. I can't find the value in use of this one property independently. Okay, same one of the classic examples of this is train and tracks. So let's say that you made a train and tracks to carry your goods from one location to the another. It's a private train. It's not kind of like owned by any other government authority. You have a train, you have tracks. Can you tell the value in use of the train and the tracks independently? It's very difficult, right? It's very difficult. So in such a scenario, what they tell you is take it as a cash generating unit. Okay, take it as a. So in order to find value in use, take everything together as one cash generating unit. So this becomes one cash generating unit. Are you clear? Like, is that making sense? Why there should be a cash generating unit? Yes or no? Okay. So in case of a cash generating unit, how would I kind of like Acha, you tell me one more thing. Uh, would I account PPE as a cash generating unit as well? That means I would, once I buy machinery one, I would debit it to asset, CGU asset. This is one of the confusions everybody has. So let's say I bought machine one, I debit to CGU asset. I bought asset two, I debit to CGU asset. I bought asset three. Okay, I again, so it would be accounted for a PPE purpose also as a CGU asset. Would this happen or would this not happen? Would I account individually for PPE, or I would account it as a cash generating unit for PPE? Tell me. How do I record it for PPE purposes? So Sahil says individually PPP. Sahil, that is right, because the useful life of these assets would be different. Okay. So for when it comes to, don't do this mistake at all, that whenever you see a cash generating unit, account everything as one cash generating unit. Don't do that. It would be individual assets in the financial statements because it would have different useful life. The concept of CGU is only and only for impairment. Okay, apart from impairment, apart from IAS 36, there is no concept of cash generating unit. Okay, so that is one critical mistake we all do. Just keep it in mind. Okay, is it clear? Yes or no? Yes. So don't do this mistake. This is only for the purpose of IAS 36. Now, in case of let's say that let's say there is machine one, Then there is asset 2. Then there is machine 3, machine 2. Then there is some goodwill. Then there is some, receivables. Now let's say that these are all a cash generating unit. Okay. So let's give the value 100, 120. Sorry. Here it is 20. Here it is 250. Here it is 160. And there is 40. Okay. So this is what the carrying value of each of them in the financial statements. Okay. Now let's forget fair value for a while and let's say that value in use is higher. So value in use, I got, okay, let me see. So the total carrying value of the asset is 570. Okay. Now let's say the value in use of all these assets put together is 350. Right? Because that is why I'm considering it as a cash generating unit because I will only get one value in use for everything. Right? So in such a scenario, how would I determine the impairment of each asset? So in such a scenario, what you have to see is if there is any asset which has an indefinite life or if it is goodwill, then first of all, what is the impairment loss? Impairment loss is 570 minus 350, which is 220. Correct. So in such a scenario, what you have to do is first write off the entire goodwill in the cash generating unit. So how much is the goodwill? 160. So the entire 160 I would write off. So the balance is how much? Is 60. This 60 I would apportion between these assets in the value of their. So it would be in here impairment loss would be 60 is the remaining after goodwill, correct? 60 into 100 divided by 100, 120, 120 plus 250, 370. Okay. Here it would be 60 into 20 by 370. Here it would be 60 into 250 divided by 370. So if you total all this, you should get 60. Yes. Goodwill is fully written off and receivables we will not write off because it is out of scope of impairment. So let's take the total. So 220 is the total impairment loss, correct? And what would be the revised carrying value? Revised carrying value is going to be 100 minus old. Okay. Did you understand that example? How you have to apportion? First, if you have a reduction, if you have a impairment loss, first take it to goodwill. Okay. If the CGU has a goodwill, then you take it to goodwill. And rest of the things you apportion between assets based on the weight of their carrying value to the extent that they are in the scope of IAS 36. Did you understand CGU? Yes or no? Or was my voice breaking or okay? So it's pretty simple. First take the entire IL and write off the goodwill. Remaining, you understand which are the assets which are in scope of IAS 36. Apportion the remaining in impairment loss to them. As simple as that. That's how you will do it for CGU. Okay, and why CGU is because I cannot find value in use differently. I can only find value in use as one. Okay, this is the whole concept. Now let's go back and read. So when it is not possible to calculate the recoverable amount of a single asset, then that of its cash generating unit should be measured instead. IAS 36 goes detail about the important concept of CGU. As a basic rule, the recoverable amount of an asset should be calculated for the asset individually. However, there will be occasions when it is not possible to estimate such a value for an individual asset, particularly in the calculation of value in use. This is because cash inflows and outflows cannot be attributed to the individual asset. If it is not possible to calculate recoverable amount for an individual asset, the recoverable amount for an asset CGU should be measured instead. That's what we did. Okay. Yeah. So there is, it's okay. This is all simple questions like, I think you can do it. It's not much of a thing. Now we'll go to impairment of goodwill, which also we had touched upon. Okay. In case of a goodwill, each unit of a goodwill is also should be lower. That's okay, but whenever there is an impairment when and the cash generating unit has a goodwill, apportion the entire thing to the cash generating. I mean, apportion the entire thing to the goodwill first, and then remaining you write off the other assets. Okay. So again, they say that the goodwill should be tested for impairment every year, not just looking at indications. Even if there is an indication or not, you should kind of go and check the recoverable value of goodwill every year. Okay. Now let's do this question. It's the same as what we did. A CGU unit comprises the following: building 30 million, plant and equipment 6 million, goodwill 10 million, current assets 20 million. Following a recession and impairment review has estimated the recoverable amount of CGU to be 50 million. Okay, how do we record? You tell me how we do this. Yes. So first, is there an impairment loss? Is there an impairment loss? Is there an impairment loss? Yes or no? Yes, because the value in use, the recoverable amount is 50 million and the carrying value is 66 million. So there is an impairment loss of how much? 16 million. Okay. Now that 16 million, how would I apportion between these assets? How would I apportion between these assets? Yes. How would I apportion? Can you quickly do it in calculator? I know you guys are more than. First deduct goodwill. Okay. So, out of 60, I want it like this 60 and, you know, out of 60, 10 to goodwill and remaining. So like that, I've given you a chat comment. 60 is the total impairment loss, 10 to goodwill. How about the remaining 6? Yes, you can't take this much time for doing such a question. Okay, impairment loss is 16. Fine. Okay, then 16 out of which 10 goes to goodwill. How about remaining 6? Hello. Okay, Sahil says the remaining 6 would be split into building and plant and equipment on the basis of their carrying amount. So what it would be 6 into 6 by 36. So it would be 1 and it would be 5, correct? Because it's 5 is to 1 ratio, it would be split. So 5 will go towards building and 1 toward. What about current assets? It will not be taken because it's not in the scope. Okay. So this would be how it is. So first 10 will go fully to goodwill. Rest, it would be taken in the proportion of their carrying value. Current assets will not be written off because it's not in the scope of IAS 36. Yes. Okay. Fine. Now, accounting treatment of an impairment. Is it clear this one? How do you handle CGU? Any doubts in CGU? Yes or no? Yes or no? Am I audible? Is there any problem with my audio? Okay. Anyways, let's go on. Okay. You guys are with me, right? I mean, is there any technical glitch? Okay, everything is fine. Fantastic. Thank you for that, Sahil. Now, accounting treatment of an impairment loss. If and only if a recoverable amount of the asset. Okay, what is the accounting treatment of an impairment loss? Before that, we have already seen here, right? We have seen accounting for impairment, right? So that's what you're going to do. Assets carrying amount should be reduced. See, carrying amount in red in bold they have given, not the cost. It should be carrying amount. Should be reduced to recover amount in the statement of financial position. The impairment loss should be recognized immediately in profit and loss unless asset has been revalued upwards, which in case the loss is treated as a devaluation decrease. You understand that, right? If there was a revaluation reserve in respect of an impairment loss asset, then you have to first take it to the revaluation reserve and remaining would be coming here. Okay. Then how about then after reducing the asset, the depreciation would be on going forward, like on a prospective basis, the depreciation would also change. Okay. So let's do this question now. It's pretty simple. Okay, before we go to reversal of an impairment loss, you understand impairment, right? Once we do impairment, accounting for impairment, we will take it directly to this. If there is a cash generating unit, then you know how to. If there is a cash generating unit, then we will take it on the proportionate pro rata basis. okay, to each individual asset. And and also if there is further depreciation, further depreciation would be calculated on 80 for the remaining future life. Okay, further depreciation would be calculated on 80, not on 100, for the for how much future period or how much useful life is remaining. That would be how we will calculate depreciation. And reversal of impairment, I think you already know this. Like, you can see the annual assessment to determine whether there might be some impairment should be applied to all assets, including assets that have been impaired in the past. In some cases, the recoverable amount of an asset that has previously been impaired might turn out to be higher than the asset's current carrying amount. In other words, there might have been a reversal of some of the previous impairment loss. In which case, the carrying amount of the asset should be increased to its new recoverable amount, and the asset is carried at revalued amount. And if the asset is carried at revalued amount, the reversal of the impairment loss would be accounted for as a revaluation increase. Okay, in other comprehensive income and accumulated revaluation surplus. If the asset is not carried at revalued amount, the reversal should be recognized immediately in P&L. That is fine, but I was looking for a question to. I don't think this is it. So let's do a question on reversal. Let's do a question on reversal just to kind of make sure that we understand. Okay, so let's see that let's say that I purchased the asset on 1st January 20x1 for 60,000. Okay, and let's say that I have a 10-year useful life. No, scrap value. Okay, I will do this one just for understanding. Okay, now let's say that I bought an asset. Now in 31st Jan 20x1, would I do a depreciation? Would I kind of consider depreciation? Yes. Now how much would be the depreciation that I would take? It is going to be 60,000 minus 0 divided by 10. So it's going to be 6,000. Okay, same thing I would do for all these years. Now what happens is, let's say in year 5, okay, at the end of year 5, so that is 31st Jan 20x5, I am doing an impairment. Okay, and I say that the value of the asset is going to be 20,000. Or let's take year 3 for simplicity. The value of the asset, let's say, is 32,000. Okay, so in such a scenario, how much is the impairment? What is the impairment loss? That is carrying value of asset. What would be the carrying value of asset? Carrying value would be cost minus accumulated depreciation. So 6,000 into 3 years, right? So the carrying value of the asset is 42,000. The recoverable amount is now at the end of year 3. I am saying that it is going to be 32,000. So there is an impairment loss of 10,000. How do I take this impairment loss? I will take it directly to SOPL. Correct? If you have any problems in understanding this, just let me know. Okay. So I will take it to SOPL. Right? So in 31st Jan 2023, so let's 31st Jan 20, oh, sorry. So in 31st December 2023, 20x3, the carrying value was 42,000. Impairment is 10,000. Revised carrying amount is 32,000. Right? Now, what would be the depreciation on 31st December 20x3? Sorry, December 20x4. What would be the depreciation? It is going to be 32,000 divided by remaining useful life. So 3 years have gone. Now I have 7 more years, right? Is it 4 years? Wow. 20 x1, x2, x3. Only 3 years divided by 7. So it is going to be, this is going to be the yearly depreciation going forward. Is it clear till now how you find the prospective depreciation? Okay. Now let's do a reversal. Now what is happening is, let's say in 31st December 20x6, what I find is, like, the revised the recoverable value of the asset is now around 48,000. I am finding it something like that. Okay. So what is going to be my carrying value in 31st December 2026? In 31st December 20x, so 32,000 minus 32,000 divided by 7 into how many years? 24, 25, 26, 3 years. So the carrying value of the property is 18,285. You know how I got 18,285? After 32,000, I reduced 4,571 for the next 3 years. So the carrying amount is 18,285. So what would be my impairment gain, or, like, reversal of impairment loss? Now that is where you have to exercise a little caution. You can't just take the difference between both of them. Okay, this may be hidden in the question, so you can't take just the difference between that and do it. What you have to ideally do is, you can't, the impair revision is not 29,000. What you have to ideally do is, you have to see what is the amount, carrying amount, in case there is no depreciation. So carrying amount in case, sorry, there is no impairment, of no impairment in 20x3, then it would have been 6,000, sorry, 60,000 minus 6,000 into how many years till 31st December 26? 1, 2, 3, 4, 5, 6. Okay. So 6 years. So the carrying value of the asset in case of no depreciation, if there was no impairment, would have been 24,000. The revised recoverable amount is 48,000, right? But I can, and the carrying value is 18,285, right? Even though the recoverable amount is 48,000, I can only change 18,000 to 24,000, nothing else. So the impairment revision of impairment loss is going to be only up to 24,000. The revision is only going to be for 5,704. So this 5,714, we had previously given in SOPL 10,000, right? So we will revise, we will consider this as a gain, and we will debit the impairment. So there would be debit accumulated impairment. That would be 545714.2857, and credit SOPL as whatever head you like, and that is going to be the same. Okay. So the impairment, accumulated impairment, accumulated impairment thing would be uh, after revision of this. So this is how you would be doing the calculations. Is it clear? So the lesser depreciation you took after impairment and the remaining impairment loss would be adjusted, and it would be 24,000 on which you will be calculating the depreciation going forward. Is it clear how the reversal of impairment? Only thing is you should kind of consider if the impairment had not happened at all, what would be the carrying value of the asset on the date of revision of impairment? That should be the amount that you have to take. Is it clear? Is there any doubts? Okay, fantastic. So that is revision of impairment, but again, it's not as frivolous or it is not as frequent as what we see in revaluation gains or losses. It is, see, you have to substantially prove that this impairment means, I mean, this impairment revision means there is actually a breakthrough, and it is not just a upside of the market. There is something really going through. Then only you can kind of do that. Okay, that's all for this chapter. I think the rain is also coming and hitting us now. So, what I want you to do is, if you look at, if you look at the entirety, we have done till chapter 5, correct? Now, what I want you guys to do is just go to this particular document, which I have shared with you. During the weekends, what I want, and they have done actually part by part in the sense they have given what questions corresponds to which one. So, revenue, there are three questions, which is of 25 marks, right? And there could be accounting for tangible non-current assets, including it. So now you can try from question 2 or question 1 to question 8. You can kind of attempt. So this is already like, you take some questions and do and try typing it off, because that's the only thing which would really help us. We all can understand the standard very easily, but applying the standard is a different thing altogether. And that practice would only come if you practice these questions. So whenever, say, tomorrow accounting for leases would be done, then you have till 10. Then there is, what I want you to do is like, every weekend, just now, whatever weekends are left going forward, just do these questions, because it would really help you build a very strong understanding of the standards. Okay, use this book. It's pretty good. Okay. And I would love to do, or what I can do is, if you don't have time to do this, we can do this together. But the problem is, if I explain and do right, you would not get the feel of doing it. So just have the feel of doing it, or what we can do is two questions I will do and two questions you guys need to do from home, the way it has to be explained. So we can think about it like, how we have to hit these. But now I think we are ready to kind of attempt from question 1 to question 8. Okay. So with that, let's wrap up for today. Any doubts? Hmm? Any doubts on impairment? Yes.
Hello?
Yes.
Sir, like for revaluation method, like assets under revaluation method,
Yes.
uh, if like in case like after a year it's showing impairment, so should we do the impairment or should we just say that we are uh, showing a revaluation loss?
See, there is a thing, right? I mean, revaluation, unless it is, we have a policy of revaluation also. We can do it once in 5 years. We can do it once in 10 years based on the intensity of the asset. So let's say that if the revaluation policy is to do revaluation every once in 10 years. Okay, but in the fifth year, I see that there are extreme cases of impairment, or there is extreme indications of impairment. Would I have to do an impairment? Wouldn't my revaluation
Yep.
last done as 5 years old?
Okay.
Okay, so this will happen. If the revaluation policy is such that you're doing it every year, then there is no need for impairment. Okay. But sometimes your policy might be that you're doing it only once in 5 years or 6 years or 3 years or etc. In such a case, it would
Okay.
be a problem. Okay.
Okay.
See, you might be having an IP and you might be doing revaluation every 3 years. But the problem is your competitor found a better IP, okay, which could essentially liquidate you in the next 2 years. You should definitely do impairment. You can't say that my revaluation policy is 2 years old. Okay, but that's a good doubt. That's a very valid doubt to have. But just try these questions also. I think in this we did one gamma because I didn't want to exhaust the questions. But just try doing this. I think we are on the right track. If during the weekends or after going home, just read this one time. Okay, what was done? It is not rocket science. With the understanding you had in class, you can easily do. Okay, and just try one of these questions and it would be all sorted for you. Okay, right. So let's end this here, and tomorrow we will be doing uh leases. Okay, so let's start at 9 sharp or 9:15 maximum. Let's not take it more than that. Okay, and any questions on impairment, you let me know. Right, so we'll stop it for today. We'll see tomorrow 9 a.m., 9:15 maximum, or 9:10 to 9:10. Okay, that is a maximum leeway. Let's get on by 9:10 so that we can finish by 10:30 like this. Thank you guys, see you tomorrow.